course, by putting the right options trading strategies in place, what seems to be complex theory can easily become an incredibly powerful tool to enhance your portfolio. Today, we will discuss 10 options trading strategies that can be effectively applied to maximize returns while minimizing risk. One of the options strategies we're going to discuss today is how one can make money even when there is little movement of the stock price. Well, if you want to learn how, then stick around and make sure to subscribe for more on investment strategies and financial tips. Number 10. Covered call strategy. The call option is one of the most popular strategies in trading options. In short, it simply means ownership of a stock and selling a call option on the same stock, whereas the account is actually bringing in income while the owner is holding the asset. That is to say, for every 100 shares of stock, an investor sells one call option. As a result, the premiums earned through the call option give additional income and cushion the downside also to a small extent. This is a wonderful strategy when the investor expects the stock to remain flat or register a slight uptick. When the stock price rises above the strike, shares are sold at the agreed strike price, and the investor retains the premium. Out of this, though, he or she also forfeits any additional gain that could have been above the strike price. Covered calls are widely utilized by investors looking to generate income on stocks that they already own, while being comfortable selling their shares if it hits a certain level of price. The profit and loss graph of covered call resembles a short put, wherein the premium cushions the downside but limits upside gains. Number 9. Marry put strategy. The marry put is a very common protective strategy. Buying put options when a person is long the stock involves buying one put for every 100 shares of stock that you own. This is utilized for protection if a person expects the stock to drop in price. The marry put works much like an insurance policy. As the stock's price falls, the put increases value, offsetting losses from the loss. The trade-off is, if the stock price does not drop, the investor loses the premium paid for the put. However, the investor has benefited from the upward movement of the stock. In other words, if you bought a stock of 100 shares and simultaneously bought a put option, your losses are limited only to the strike price of the put minus the premium. It is the best strategy when an investor is willing to retain a stock but has a great concern for short-term downside risk. Number 8. Bull call spread strategy. A bull call spread is a vertical spread in which there is buying of the call option at one level of the strike price, with selling of another call option at a higher strike price. The date of expiration and the underlying stock will be the same for both options. This strategy will work better for investors who are moderately bullish on a stock. It lowers the potential profit but makes buying into the trade a little cheaper by selling the higher strike call. Maximum profit is achieved when the stock price rises at or above the strike price of the sold call. The bull call spread allows investors to take advantage of upward price movements, while it requires a lot less capital than simply a call option. The trade-off, however, is that upside potential isn't great as profit is capped at the difference between the strike prices minus the premium paid. Number 7. Bear put spread strategy. The bear put spread. This is the exact opposite of the bull call spread. Here the investor buys a put option at one level of strike price and sells another put option at a lower level of strike price. Both options expire in the same month and on the same underlying stock. This strategy would apply when the investor expects the stock price to decline, though not massively. Compared to buying a simple put option, the bear put spread limits the risk and potential loss. As is similar with the bull call spread, the profit is also capped by the difference between the two strike prices less premium. Bear put spreads allow investors to profit from declining prices while reducing the cost of the trade compared with buying outright puts. The negative side is that the gains are limited even if the stock falls heavily. Number 6. Protective collar strategy. State the strategy of a protective collar if one wants to lock in gain on a stock and also protect it against downside. This would consist of buying an OTM put and selling an OTM call simultaneously, which is usually done after significant rise in the stock. For example, an investor holding 100 shares of a stock may sell an OTM call and buy an OTM put. The put protects against a large downside move, while the call limits potential upside gains. If the stock is above the call strike price, the investor will get exercised and forced to sell the shares at the call's strike price, crystallizing profits. On the other hand, if it falls, the put limits the decline. The VAR. Protective collar strategy really combines the concepts of a covered call and married put, balancing risk and reward. Number 5. Long straddle strategy. The long straddle is an appropriate strategy for the investor who thinks there will be a major price move in the underlying but is uncertain on direction. The strategy involves the simultaneously purchasing of a call at a put at the same strike price and expiration date. If the price of the stock significantly moves up or down, one of the options will become profitable. The investor's maximum risk is limited to the combined premiums paid for both options. This strategy can lead to unlimited potential gains if the stock makes a large move, but losses are capped if the stock stays relatively unchanged. The long straddle is often used before major events such as earnings reports or regulatory decisions, where volatility is expected but the direction is uncertain. Number 4. Long strangle strategy. A long strangle is similar to a long straddle, except with this strategy, the investor buys both an out-of-the-money call and an out-of-the-money put. Unlike in the straddle strategy, both options are different. That is, the two options have different strike prices. Because both options are out of the money, it is less expensive to execute the long strangle compared to the long straddle. It does take a greater price move to be profitable. This strategy would be executed by traders anticipating high volatility who are looking to limit their initial investment. Long strangles are set up when a large price swing is likely to happen, as in major corporate announcements or in most geopolitical events. Number 3. Long call butterfly spread. A long call butterfly spread combines components of both bullish and bearish strategies. To establish this spread, an investor buys a call option at the lowest strike price, sells two call options at a middle strike price, and purchases another call option at the highest strike price. All the options carry the same expiration date. The strategy is implemented by those investors who anticipate negligible price movement in the underlying asset. It realizes its maximum gain if the stock price remains close to the middle strike price at expiration. The risk is limited to the net premium paid for the options, and maximum loss occurs if the stock price moves significantly away from the middle strike price. A butterfly spread is a low-risk, low-reward strategy for an investor to reap the benefits of stable stock prices. Number 2. Iron condor strategy. The iron condor is a directionally neutral strategy, but one that also seeks to exploit low volatility. It involves holding both a bull put spread and a bear call spread. An investor is seeking for the stock to expire within a particular range to realize maximum profit. The structure gives a net premium to the iron condor. The maximum profit is received when at expiration, the stock price falls between the two middle strike prices. If the stock is considerably out of this range, then there are limited losses by the outer strikes of the put and call options. The best strategy for an investor who thinks the stock will trade in a certain range and is looking for a way to take advantage of small price movement. Number 1. Iron butterfly strategy. The iron butterfly is another neutral strategy that combines selling an at-the-money straddle and buying protective wings, which comprise one out-of-the-money call and one out-of-the-money put. The idea is to collect income from the net premium while limiting the risk on both sides. The maximum profit is realized if upon expiration, the stock stays at the strike price of the straddle. The losses are limited if the stock travels out of the range of the wings. This is an excellent strategy for traders who anticipate little movement in the price of the stock, but wants to hedge against big swings either way. The iron butterfly strategy combines high probability for a small gain with very limited risk on both sides of the trade. There are numerous options trading strategies available, depending on various market conditions and risk tolerance. From the protective collar to the iron butterfly, the alternative ways above all discuss managing risk, generating income, or capitalizing on market movements. It should be kept in mind that you must understand the strategy in detail and then consider whether it meets your needs and expectations regarding investment. Always research more about these strategies and consult an independent financial advisor before using them. Don't forget to like this video and subscribe for more trading insights and tips.